Hi everyone, we are Group 11. Our topic is the impacts of changes in accounting standard on leases. And here is our group member. The first is me, Zitian Wang. The second is Chen Sun. The third is Jeanette Tan. The first is Feng Chuan. And the fifth is Nan Wang. There is a new approach to lease accounting has been issued and developed by the IASB and the FASB since 2010, which is called exposure draft. It would recognize all assets and liabilities arise under lease contracts on entity's balance sheet, which makes their influence on different sides. Now here are the answers about question 1. According to the definition, the debit counts leading agreement between a borrower and a creditors, which usually contain limitation for certain financial ratios that the borrower may not break. It is a kind of safety net to decline conflicts and interests between borrowers and the creditors. It would be a preservation of repayment capacities or a protection against the credit damaging events. More importantly, the debit covenants would be the signals and triggers for increased repayment risks. As in IFRS, there is a negotiation that leases will see an increase in their leverage under the new standards, those debit covenants may be triggered. That is because the new standard will influence their key financial ratios, which used to determine company valuation and the credit worthiness. And here is the reasons. The lease agreement or real estate are part of operating leases is not being recognized on the balance sheet by most companies currently. However, by applying new standard, those operating leases are treated as the rental expenses or revenues, which should be reported in the income statement. It will have impacts on lower lenders and the lower working capitals and higher present value of cash flow on the borrower side. At the same time, the cost of lease will also increase due to the change of the revenues on the creditor side. To drop the increased risks for creditors, regulatory capital requirements might increase the amount of risk-weighted assets and therefore affect the regulatory capital needs of borrowers in their financial leverage. In addition, it would also be illustrate higher level of dividends, the negative net present value, and the higher tangible assets ratio and the lower interest coverage ratio on the financial statement. In conclusion, debit covenants may be triggered as a possible result finally. And the next part is Chen.
Hi everyone, I will start discuss some basic concepts related to question 2. First, we will look at the operating lease, financial lease. Second, we will look at optimistic perspective and efficiency perspective. For the operating lease, according to IASB 117, paragraph 33, lease payment should be recognized as the expense in the income statement. For the financial lease, IASB also have the requirements, which is in the paragraph 20. Lease shall be recognized as the assets and liabilities in the balance sheet. Next, we will look at optimistic perspective, which managers plan to act optimistically to maximize the personal benefits rather than company's interest. So it's more managers focuses on their personal interest and to gain more personal wealth rather than the company's perspective. Next, we will look at the efficiency perspective. Managers choose accounting methods which present underlying performance of the company. So in this way, management actually can consider the company as a whole rather than from the underlying problem. Next, we will discuss more details related to the case. I start with operating lease as well. So to recognize the lease item according to the accounting standard, it should be realized in the expense. Therefore, the expense should be increased. So, but the expense only have impacts on the income statement, so there's no changes in the balance sheet. Therefore, there's nothing going to change for the financial ratios, which debitors are actually focused on. From this perspective, from the optimistic perspective, managers actually do like this approach because nothing is going to change the financial ratios and which the company looks like in a very healthy and positive situation, rather than it's in fact what it actually is. Let's say the financial lease. Since the company who leases are required to recognize the leased item as liabilities in their in their balance sheets, so there will be an increase of the total liabilities in the balance sheet. Therefore, there might be some ratios change, and most of them will change in a negative position. So from the optimistic perspective, managers do not like this approach because they want the companies to show they actually works really well. In conclusion, the new standard actually going to have impacts on how companies stand for operating or financial lease. Next, I will pass on to Janet. She will discuss about question 3. Thank you.
Thanks, Cheng Cheng. Now I'm just going to explain question 3, which is whether debt holders would prefer more leases to be recognized or to be kept off the balance sheet. Well, first of all, a borrowing company would account for their operating leases as such. They would recognize their lease receipts as revenue over the term of the lease on a straight line basis, and so any initial direct costs will be capitalized as part of the carrying amount of the asset. In this way, cost of incentives are treated as reductions in the lease revenue receipts over the term of the lease, also on a straight line basis. Following this logic, it means that operating leases only affect the income statements of a borrowing company. As for finance leases, a borrowing company would de-recognize their asset and record a lease receivable over the net investment of the lease, and it will be recorded at an amount that equals to the net investment. Lease payments will be recognized as income over a lease term on a straight line basis as well, and the receipts will be allocated between lease receivable, interest revenue earned, reimbursement of costs paid on behalf of the lessee, and receipts of contingent rent. Finance leases affect the balance sheet of a borrowing company and thus its debt-equity ratio. Now, following the debt-equity hypothesis in the positive accounting theory, managers are more likely to prefer accounting methods that would appear to increase the income of the company, especially when debt-equity ratios are high, and that would mean they would lean towards operating leases, as that only affects the income statements, as I mentioned before. However, finance leases will affect the balance sheet and thus their debt-equity ratio. In this way, finance leases can be seen as being more honest, because that use the most reliable financial statements for debt holders to analyze the borrowing company's financial situation. Therefore, in conclusion, according to the debt-to-equity hypothesis, debt holders would prefer leases to be recognized and disclosed on the balance sheet in order to make informed decisions as to whether they would like to lend to a borrowing company. And I've concluded question 3, and I'll now pass on to Fong for question 4. Thank you.
Okay, thank you, Janice. Now I would like to move on to question 4. It's talking about if the shareholders that they prefer the lease will be recorded on the balance sheet or not. Yeah. So now, firstly, I would like to write out a very simple example about how finance lease will be recorded. And firstly, when you see the balance sheet on 30th of June 2013, at that time we haven't got financial lease yet. So the cash and the total asset, total liability, and the equity only 300,000, sorry. And now when the company got the lease and they write out on financial lease, they will fight for balance sheets. For example, if firstly, the lease access will be recorded in the debit 300,000, and the liability, the lease liability, will be recorded as well 300,000. And why I write 20,000 there? Is that one advance payment for the first year, and the 2,000 repaid there is going to be executed cost. And we have to pay by cash, so that's why the 22,000 come from. And when at the end of the year, balance sheet on 30 June 2014, and the cash lease access, cash liability will be changed. Example, cash will be reduced 378,000, and the repaid security 2,000, and lease access and lease liability will be changed. But interestingly, when you see total assets and liability change, but equity is unchanged. So because equity unchanged, but liability and asset change, so that's what is a factor debt ratio. When you see it on the 2013, it's only a third. But when you got lease is 300,000, and they change 3.8 over third. You see, that's why it changed. When they change, what is a fact? I want to now we will go to next slide, and I would like to that hypothesis to like an example. Increasing the equity ratio may result in increasing interest rate and decreasing the level of fund that company can borrow from the lender. And the third one, maybe they can breach in the covenant ratio, because when they got agreement, normally they set the ratio, for example, they set 0.5, but if when they got a financial lease, they can put up the ratio 0.6. That means they're reaching the ratio. So for the 3 reasons, I want to conclusion, the shareholder want to keep off balances. It means they would like refer operating expense rather than financial lease. Yeah, thank you. I want to finish, and now I would like to move on to Nene. She go to the question 5.
Thank you for presentation. In the final part, I will introduce the hypothesis that can be applied in this case. Firstly, I will indicate the bonus plan hypothesis. At the beginning, I want to explain some knowledge of the hypothesis. From this slide, you can see that there are 2 roles in this relationship, in this hypothesis. One is the shareholder, another is the manager. They have their own purpose. For example, the shareholder have tended to get more profits but less knowledge on management. However, managers have paid more attention on gaining their own profits and less interested in the company's profit. Normally, the rewarding managers have 2 methods, such as fixed basis and salary plus remuneration. In fact, the manager with fixed basis has less patience and have not motivation to take a great risk, as there is no extra gain from shares. Well, Healy in 1985 has indicated that the manager could gain the bonus when the company's earning exceeds the company's target. In order to motivate motivate the managers, the shareholder has tried to use this method is salary with remuneration. However, this hypothesis has also led to a problem of inducing the manager manipulate accounting numbers, which has affected their rewards. Well, new standards has disclosed more leases that will give the shareholders to understand how managers' performance in the accounting balance. Secondly, I will introduce the debt hypothesis. From here, you will see there is a relationship between the firms and the debt holders. Indeed, the debt holder want to get the profit. However, they have also need to take a great risk. On the contrary, the firm have tended to get more debt from debt holder for their investment. Normally, before debt the money for the firms, the debt holder have tended to check the statement of financial position. If use the before standard, the debt holder cannot spend too much on the leases, which are terms more than 12 months. They may recognize the companies have much equity and less liability, that firms have ability to return the debt for the interests. Whatever the bankrupt, the equity has been priority offset to the debt holder and for the shareholder later. So the new standard has provided the more financial information of firms for the debt holder. This means the debt holder have gained more information of the firms and may refuse to debt the money for the firms as bad financial condition. It is obvious that the firms have not like a new standard. However, debt holder could get advantage from new standard as getting more information to judge the decision of the debt. Thirdly, the policy cost hypothesis has also been applied in this case. If the higher profits of the companies may attract the company's attention, this may result in increasing tax, wage claims, and product boycott. In order to avoid this cost, Gensler, Lillian, Pastner in 1986 have indicated that the firm have tried to reduce their profits to lower the political scrutiny. However, new standard has exposed more profits that companies tried to hide. It is clear that the firms have not enjoyed the new standard, but the government has preferred new standard as more transparency information from the companies. In conclusion, in the first part, Jojo has illustrated the new accounting standard trigger debt governance. Secondly, new accounting standard has influenced the companies. Thirdly, debt holder has not preferred to recognize the leases as debt hypothesis. At fourth part, Tree has indicated that the shareholder has tended to keep off the balance sheet as a debt hypothesis. Finally, part has introduced these three key hypotheses applied in the case. That's all of our presentation. Thank you for your listening.